Most people do not struggle with money because they are completely uninformed. They struggle because money decisions happen in real life, under pressure, with emotions involved. A person can understand that saving is important, but still spend too much when they feel stressed. They can know that investing should be long-term, but still panic when the market falls. They can promise themselves they will avoid risky choices, then suddenly chase something because everyone around them seems to be making money from it. The problem is not always knowledge. Very often, the problem is behavior. This is where the central idea begins. There's a gap between what we know we should do and what we actually do when emotions take control. Almost everyone has experienced this gap in some form. You may know you should not check your investment account every day, but you still open the app when the market is moving. You may know you should not compare your financial life to someone else's, but you still feel behind when you see another person buying a new car, moving into a bigger house, or talking confidently about money. You may know that wealth takes patience, but patience becomes difficult when the world is full of noise, advice, predictions, and pressure. Money is not just math. If money were only math, then good decisions would be easy. Everyone would spend less than they earn, save consistently, invest patiently, avoid unnecessary debt, and ignore market panic. But real people do not behave like spreadsheets. Real people have fear, regret, pride, hope, embarrassment, family pressure, social pressure, and dreams for the future. These emotions shape decisions more than most people admit. Sometimes a bad financial choice does not begin with greed. It begins with anxiety. Sometimes it does not begin with carelessness. It begins with wanting safety, comfort, or approval. One of the most important lessons is that people often make financial mistakes when they try to remove uncertainty. They want the perfect answer. They want to know exactly where the market is going, which investment will perform best, when to buy, when to sell, and how to avoid every possible loss. But the financial world does not offer perfect certainty. Markets move in ways people cannot fully predict. Life changes in ways people cannot fully plan. Jobs change. Families change. Goals change. Emergencies happen. And opportunities appear at unexpected times. Try and control all of this can make people more anxious, not more prepared. A better approach begins with honesty. Instead of asking, what is the best investment? The better question is, what am I actually trying to do with my money? This sounds simple, but it changes everything. Money should not be separated from life. A financial decision should connect to a real purpose, like providing stability for a family, buying freedom from constant stress, building independence, preparing for retirement, starting a business, or creating space to do meaningful work. Without a clear purpose, people become vulnerable to every new opinion. One expert says one thing, another says the opposite, and suddenly the person is confused, emotional, and unsure what to do next. This is why behavior matters so much. Two people can have the same income, the same investment options, and the same information, but end up with very different results because they behave differently. One person reacts to every market drop and keeps changing their plan. Another person stays calm, follows a simple strategy, and gives time the chance to work. One person uses money to impress others and keeps increasing their lifestyle. Another person uses money to create flexibility and peace. Over time, these small behavioral differences become huge. Financial success is often less about finding one brilliant move and more about avoiding repeated emotional mistakes. The danger is that emotional mistakes usually feel reasonable in the moment. When markets are rising fast, buy more feels smart because everyone seems optimistic. When markets are falling, selling feels safe because fear becomes louder than logic. When someone else appears successful, copying them feels practical because their results look convincing from the outside. But in reality, these decisions are often reactions, not plans. They are responses to fear, excitement, envy, or pressure. The person may not even realize they are being emotional because the decision feels urgent and intelligent at the time. A major part of improving with money is learning to pause before acting. Not every feeling needs to become a financial decision. Fear does not always mean you should sell. Excitement does not always mean you should buy. Feeling behind does not mean you should take bigger risks. Feeling confident does not mean you can predict the future. The pause creates space between emotion and action. That space is where better choices happen. It allows a person to ask, is this decision connected to my plan, or am I reacting to something temporary? This does not mean people should ignore emotions completely. Emotions are part of financial life because money is connected to survival, identity, family, freedom, and security. The goal is not to become emotionless. The goal is to understand your emotions well enough that they do not secretly control the plan. A person who knows they panic during market drops can prepare for that before the drop happens. A person who knows they overspend when stressed can create boundaries before stress arrives. A person who knows they compare themselves to others can focus more clearly on their own goals instead of chasing someone else's life. Simple financial behavior is powerful, but simple does not mean easy. Saving regularly is simple, but not easy when expenses rise. Staying invested is simple, but not easy when headlines are frightening. Living below your means is simple, but not easy when society rewards looking successful more than being stable. Talking honestly about money is simple, but not easy when shame or pride gets in the way. The difficult part is not usually understanding the rule. The difficult part is practicing the rule when emotions are loud. The real message is that better money decisions begin with better self-awareness. Before a person can build a stronger financial life, they must understand how they behave under pressure. They must notice the patterns that keep repeating. Do they panic? Do they chase trends? Do they avoid looking at the truth? Do they spend to feel better? Do they compare their progress to others? Do they keep changing plans because they are uncomfortable with uncertainty? These questions are uncomfortable, but they are also useful. They move the focus away from blaming markets, experts, luck, or timing, and bring attention back to the part a person can actually control. A healthy financial life does not begin with a product. It does not begin with a stock, a fund, a retirement account, a business idea, or a prediction about the economy. It begins with a much more personal question. What is the money for? That question sounds simple, but most people avoid it. They jump straight into decisions before understanding the reason behind those decisions. They ask what to buy, where to invest, when to move, how much risk to take, and which opportunity is best. But without knowing the purpose, even a smart financial move can become the wrong move for that person's life. This is one of the biggest mistakes people make. They treat money as if it exists separate from the life they are trying to build. They compare returns, listen to opinions, follow headlines, and chase whatever looks impressive. But money is not valuable by itself. It is valuable because of what it can protect, create, and support. It can protect a family from panic during an emergency. It can create independence from a job that no longer fits. It can support time with children, care for aging parents, a business dream, a peaceful retirement, or the ability to say no without fear. When money is connected to real life, decisions become clearer. Many people think financial planning means try to become as rich as possible, but that is too vague. More money may help, but more money without direction can also create more confusion. If a person does not know what enough looks like, they can keep chasing forever. They may increase income and still feel unsafe. They may invest more and still feel behind. They may own more and still feel empty. This happens because the goal is not defined. Without a real goal, the person is not building a financial life. They are only reacting to the next desire, fear, or comparison. A useful money goal must be personal. It cannot simply be copied from a friend, a financial influencer, or a successful person online. One person may want to retire early because freedom matters more than status. Another person may enjoy work and want to build a business for the next 20 years. One family may value a paid-off home because it gives them emotional peace. Another may prefer flexibility and choose to rent while investing elsewhere. One person may be comfortable with market swings. Another may lose sleep over a small drop. None of these people are automatically right or wrong. The right answer depends on the life behind the numbers. This is why asking better questions matters. Instead of asking, what is the best investment? A better question is, what problem am I trying to solve? If the problem is short-term safety, the answer may not be a risky investment at all. It may be cash reserves. If the problem is retirement in 30 years, the answer may be patient long-term investing. If the problem is feeling trapped in a job, the answer may be building savings that give you options. If the problem is family security, the answer may include insurance, debt control, and a realistic emergency fund. The same financial tool can be right in one situation and wrong in another. People often skip this step because products feel more exciting than goals. It is more interesting to talk about a hot stock than to talk about patience. It is more exciting to discuss the next big opportunity than to discuss spending habits. It feels smarter to debate markets than to admit uncertainty. But the quiet questions are often the most powerful. What do I need my money to do? What kind of life am I trying to support? What would make me feel secure? What trade-offs am I willing to accept? What would I regret ignoring 10 years from now? These questions do not sound dramatic, but they protect people from emotional mistakes. When goals are unclear, people become easy to influence. A strong opinion on television can change their mood. A friend's success story can make them question everything. A market drop can make them abandon a long-term plan. A new trend can make them feel foolish for being patient. Without a clear personal reason behind their choices, they have no anchor. They move from one idea to another, always searching for confidence outside themselves. But real financial confidence does not come from knowing exactly what will happen next. It comes from knowing why you are doing what you are doing. This is where the gap between knowing and doing becomes visible. A person may know they should focus on their own plan, but when someone else appears to be winning faster, envy enters the picture. They may know they should avoid unnecessary risk, but when an investment rises quickly, greed can make caution feel like weakness. They may know they should save, but when life feels stressful, spending can feel like relief. The numbers may be logical, but the behavior is emotional. That is why good financial decisions need more than information. They need a structure that can hold steady when emotions change. A simple plan connected to real goals works like a filter. It helps a person decide what deserves attention and what should be ignored. If an opportunity does not fit the goal, it becomes easier to pass. If a headline does not affect a long-term plan, it becomes less important. If a friend's choice does not match your circumstances, it does not need to change your direction. This does not mean ignoring new information. It means not letting every new piece of information become a new decision. The plan gives boundaries. For example, imagine someone saving for a house within the next 2 years. They hear that the stock market has been rising and feel tempted to invest their down payment to earn more. On the surface, this might sound clever, but if the money is needed soon, a market drop could damage the goal. The purpose of that money is not maximum return. Its purpose is stability. In that case, protecting the money may matter more than growing it quickly. Another person saving for retirement 25 years away may make the opposite choice. Their money has time to recover from volatility, so avoiding all risk could become its own risk. The right decision comes from the goal. This kind of thinking removes a lot of unnecessary drama from financial life. People do not need to ask whether one investment is always good or always bad. They need to ask whether it fits the time frame, purpose, and emotional reality of the person using it. A good tool in the wrong context becomes dangerous. A simple tool in the right context can be powerful. This applies to investments, debt, savings, business decisions, and lifestyle choices. There is no universal answer that works for everyone because money is personal before it is technical. The next major lesson is that people often overestimate their ability to beat the market. They may not say it that way, but their actions reveal it. When they buy because they believe something will rise, sell because they believe something will fall, move in and out based on forecasts, or chase recent winners, they are acting as if they know something useful about the future. Sometimes they may be right for a while, and that can be dangerous because early success can create overconfidence. A lucky decision can feel like skill. A rising market can make a person feel smarter than they are. The problem is not that people are foolish. The problem is that the market is extremely difficult to outguess. Prices already reflect the expectations, fears, hopes, and opinions of millions of people. New information appears constantly. Events change quickly. A company can look strong and then face an unexpected problem. A market can look weak and then recover before people feel ready. An economy can appear stable and then surprise everyone. Even professionals with deep research advanced tools, and years of experience often struggle to consistently beat the market after costs and mistakes. For everyday investors, the challenge is even greater, but the emotional pull is strong. People like the idea of being clever. They want to believe they can avoid downturns and capture gains. They want to sell before the crash and buy before the recovery. This dream is attractive because it promises control. It suggests that with enough attention, enough information, or the right expert, uncertainty can be defeated. But this promise often leads people into behavior gap. They act more, pay more attention, make more changes, and increase the chance of mistakes. One of the most common mistakes is chasing performance. People see an investment that has done well recently and assume it will keep doing well. They feel safe because the past return looks impressive. But by the time something becomes popular, much of the gain may already have happened. Buying after a strong run can mean buying at a high price, driven more by excitement than by a thoughtful plan. Then, when performance cools or reverses, the same person becomes disappointed and may sell. They buy after good news and sell after bad news, repeating a pattern that quietly damages returns. This pattern is not rare. It happens because people feel more comfortable buying what has already gone up. Success creates social proof. If everyone is talking about something, it feels less risky, even when the price may already reflect too much optimism. On the other side, people feel uncomfortable buying or holding something that has recently fallen. Loss creates fear and embarrassment. Even if the long-term plan remains reasonable, the emotional discomfort can push them to act at the wrong time. The result is behavior that looks logical in the moment but harmful over time. Another mistake is reacting to market news as if every event requires action. A report comes out, a market falls, a government changes policy, a company disappoints investors, or an expert warns about danger. Suddenly people feel they must do something. Doing nothing feels irresponsible. But in investing, activity is not always wisdom. Sometimes the best decision is to stay with a reasonable plan. This is difficult because patience can feel passive. But patience is not the same as laziness. It can be an active choice to avoid emotional damage. The financial industry often makes this harder. There's always something to discuss, something to analyze, something to predict, and something to sell. News platforms need attention. Experts need opinions. Companies need products. Advisors need conversations. This creates a world where constant movement feels normal. But a good financial life may require the opposite. Fewer dramatic decisions, fewer reactions, fewer attempts to be brilliant, and more consistency. The boring choice is often the wise choice. Trying to beat the market also creates hidden costs. There are obvious costs like fees, taxes, and transaction expenses, but there are emotional costs too. A person who is always trying to time the market must constantly watch, worry, and second guess. They may feel regret after every move. If they sell and the market rises, they feel foolish. If they buy and it falls, they feel anxious. If they wait, they fear missing out. Their financial life becomes a source of constant mental noise. Even if they occasionally make a good call, the stress can be high. This does not mean people should never make changes. Sometimes a plan genuinely needs adjustment. Life changes, goals change, income changes, risk tolerance changes, and new responsibilities appear. But there's a difference between adjusting a plan and reacting emotionally. Adjusting a plan begins with purpose. Reacting begins with fear or excitement. Adjusting asks, has my life changed? Reacting asks, what is the market doing today? Adjusting is calm. Reacting is urgent. The ability to tell the difference is a major part of better financial behavior. A long-term investor does not need to predict every market movement to succeed. They need a reasonable plan, enough diversification, costs they can live with, and the discipline to stay aligned with their goals. This is not glamorous, but it is powerful. The market will always have periods of fear and excitement. There will always be reasons to worry and reasons to believe this time is different. But if every reason becomes an action, the person's own behavior becomes the biggest risk. This leads to another important idea. The search for the perfect investment can become a trap. People often believe there must be one best answer, one perfect fund, one perfect strategy, one perfect entry point, or one perfect formula. They delay action because they want certainty. They keep researching because they fear making a mistake. They compare options endlessly, hoping one choice will remove all doubt. But in real financial life, waiting for perfection can be more damaging than choosing a reasonable plan and following it consistently. The perfect investment is attractive because it seems to promise safety, growth, confidence, and no regret. People want something that performs well, never scares them, costs little, creates wealth quickly, and protects them from every downturn. But every investment has trade-offs. Higher expected returns usually come with more volatility. More safety usually means lower growth. More flexibility may mean less discipline. More complexity may create more confusion. There is no investment that removes all trade-offs. The goal is not to find something perfect. The goal is to find something appropriate. This distinction matters. Appropriate means the investment fits the person's goals, time frame, risk tolerance, and behavior. A strategy that works mathematically can still fail if the person cannot stick with it emotionally. If someone chooses an aggressive investment because it looks powerful, but then sells during the first major drop, the strategy did not work for that person. Not because the investment was automatically bad, but because it did not match their behavior. The best plan on paper is useless if it cannot survive real life. People often ignore their own emotional limits when making financial decisions. They imagine themselves as calm long-term thinkers when markets are rising. They say they can handle risk. They believe they will be patient. But risk feels different when losses are real. Seeing account values drop can create physical anxiety. It can affect sleep, mood, and relationships. It can make a person question every decision. That is why risk tolerance should not be based only on what someone says during calm times. It should be understood through honest self-awareness. How have I reacted before? What level of loss would make me panic? What would I do if my account dropped sharply? Would I stay with the plan or abandon it? A less aggressive plan that a person can actually follow may be better than an aggressive plan they cannot tolerate. This is hard for people to accept because they often focus only on maximum returns. But financial success depends on staying in the game. A plan that looks slightly less impressive but keeps a person calm and consistent can produce better real-life results than a plan that looks optimal but causes emotional mistakes. The right plan should be strong enough to grow, but stable enough to survive the investor's own behavior. The search for perfection also appears in timing. People want to invest at the perfect moment. They wait for the market to fall. Then when it falls, they become afraid it will fall further. They wait for clarity, but clarity usually comes after prices have already moved. They want proof that it is safe, but by the time everything feels safe, the opportunity may have changed. This cycle can keep people sitting on the sideline for years. They are not lazy. They are waiting for a feeling of certainty that the market may never provide. A better mindset is to accept that uncertainty is part of the deal. You do not need perfect timing to build wealth over a long period. You need a process that reduces the need for perfect timing. Regular investing, diversification, and a long-term plan can help because they remove some of the emotional pressure from each individual decision. Instead of trying to guess the perfect moment, the person commits to a disciplined pattern. This does not guarantee comfort, but it reduces the temptation to make every decision based on fear or excitement. Perfection can also hide inside complexity. Some people believe a complicated plan must be better because it looks more intelligent. They want advanced strategies, special products, unusual investments, and constant optimization. But complexity can become a form of confusion. If a person does not understand what they own or why they own it, they are more likely to panic when things change. Simple does not mean weak. A simple plan that is understood and followed can be much stronger than a complex plan that nobody can explain clearly. There is also a pride element. People may feel embarrassed by simple choices because simple does not sound impressive. It does not give them something exciting to talk about. Saying, I save consistently, keep costs low, stay diversified, and focus on my goals, does not sound as thrilling as saying, I found the next big opportunity. But the goal of financial behavior is not to sound impressive. The goal is to make decisions that support a real life. Many people damage their financial future because they want their money choices to feel intelligent, exciting, or superior. Quiet consistency rarely gets applause, but it often creates better outcomes. The idea of the perfect investment can also make people blame the wrong thing when results disappoint them. They think the problem was the product, so they switch to another product. Then that one disappoints them, and they switch again. But the real issue may be behavior. They may be expecting too much too quickly. They may be reacting to short-term results. They may be changing strategies before giving any strategy time to work. They may be chasing comfort instead of following a plan. If behavior does not change, the next product may not solve the problem. This is why the most important work often happens before the investment decision. It happens when a person defines goals, accepts trade-offs, understands their emotional patterns, and build a plan they can follow. The investment is only one part of the system. The person's behavior is the other part. Ignoring behavior is like building a strong bridge on weak ground. The structure may look good, but pressure can expose the weakness. A realistic plan should expect uncertainty, not pretend it can avoid it. Markets will decline sometimes. Investments will disappoint sometimes. Other people will appear to get rich faster sometimes. News will create anxiety. Experts will disagree. There will always be a reason to question the plan. That does not mean the plan is broken. It means the world is uncertain. The purpose of a plan is not to remove uncertainty. It is to guide behavior through uncertainty. In everyday life, this lesson applies beyond investing. A person may search for the perfect budgeting method and never actually track spending. They may search for the perfect business idea and never start. They may search for the perfect career move and remain stuck. They may search for the perfect time to save, but expenses always appear. Perfection often becomes a socially acceptable form of delay. It feels responsible because the person is researching, thinking, and preparing. But at some point, progress requires action. The better path is not reckless action. It is thoughtful action with humility. Choose a direction based on real goals. Accept that the choice will not be perfect. Build room for mistakes. Review when life changes. Avoid changing everything just because emotions shift. Keep the plan simple enough to understand and strong enough to follow. This kind of approach may not feel exciting, but it respects reality. It understands that the future cannot be perfectly known, and that human behavior must be managed, not ignored. The deeper message is that financial mistakes often come from looking outside for certainty instead of building inner discipline. People want the market to give them confidence. They want experts to remove doubt. They want products to guarantee success. They want timing to protect them from regret. But money decisions will always involve some uncertainty. The person who accepts this can stop chasing perfect answers and start making better choices. They can focus on what can actually be controlled: goals, savings habits, spending behavior, diversification, costs, patience, and the willingness to stay calm when emotions rise. When money is guided by purpose, it becomes less reactive. When investing is approached with humility, it becomes less stressful. When perfection is replaced with suitability, decisions become more realistic. The goal is not to become the smartest person in the market. The goal is to become a person whose behavior does not destroy their own plan. That shift is simple, but it changes everything. It moves the focus away from prediction and toward discipline. It moves the focus away from comparison and toward personal goals. It moves the focus away from the perfect investment and toward a financial life that can actually be lived. A strong financial life is built by repeating reasonable decisions long enough for them to matter. It is built by not letting fear turn into panic, not letting excitement turn into recklessness, and not letting uncertainty turn into endless delay. The person who learns this may still make mistakes, because everyone does, but they begin to make fewer of the same mistakes. They begin to recognize emotional patterns before those patterns cause damage. They begin to understand that the most valuable financial skill is not prediction. It is behavior guided by purpose, practiced with patience, and protected from noise. One of the most dangerous habits in financial life is treating predictions as if they are instructions. People hear a confident forecast about the market, the economy, interest rates, inflation, housing prices, or the next big investment opportunity, and suddenly they feel pressure to act. The forecast may sound intelligent. It may come from someone with a serious title, a clean chart, a professional background, or a long explanation filled with numbers. But confidence does not make the future predictable. A person can sound certain and still be wrong. In money decisions, this matters because acting on someone else's certainty can quietly pull people away from their own plan. Predictions are attractive because uncertainty feels uncomfortable. Most people do not like admitting that they cannot know what will happen next. They want a clear answer. They want someone to say the market will rise, or the market will fall, or this is the best time to buy, or this is the moment to get out. A forecast gives the mind something to hold. It feels like a map through uncertainty. But the problem is that financial markets are shaped by countless moving parts. Human behavior, business results, government decisions, global events, fear, optimism, technology, war, supply, demand, and surprises nobody saw coming. No single person can fully control or predict all of that. This does not mean every forecast is useless. Some people make thoughtful observations. Some warnings are reasonable. Some economic analysis can help us understand the environment. But there's a big difference between using information for awareness and using it as a trigger for emotional decisions. Awareness says, this is something to consider. Emotional reaction says, I must change everything now. The first one can be useful. The second one can be dangerous. Many people damage their long-term results not because they never received information, but because they gave too much power to information that was uncertain. The financial forecast often creates the illusion of control. When someone explains what might happen next, it feels like the future has become more manageable. But most forecasts do not remove risk. They simply shift attention from the plan to prediction. A person who had a long-term strategy may suddenly become obsessed with short-term movement. They begin asking whether they should sell before a decline, buy before a rally, wait for lower prices, change investments, or pause contributions. Their focus moves away from their goals and toward guessing. This is where behavior begins to break down. The emotional problem is that people usually remember forecasts that match what they already feel. If they are already worried, they pay more attention to warnings. If they are already excited, they pay more attention to optimistic predictions. If they're looking for permission to take a risk, they find someone who supports that risk. If they're looking for permission to escape uncertainty, they find someone who says danger is coming. In this way, forecasts can become emotional confirmation rather than honest guidance. The person thinks they are making a rational choice, but they may simply be choosing the opinion that matches their current mood. This is why advice must be handled carefully. Advice is not automatically bad, but advice without context can be harmful. A smart recommendation for one person can be a poor recommendation for another. Someone may say an investment is good, but good for whom? Good for what time frame? Good for what level of risk? Good for what goal? Good for someone with stable income or someone with unstable income? Good for a young investor or someone close to retirement? Good for a person who can handle volatility or someone who panics during losses? Without these details, advice can sound useful while missing the most important part, the person receiving it. Most people do not need more random advice. They need better filters. The world is full of opinions. Financial media, social media, friends, family members, co-workers, business owners, investors, and experts all have something to say. One person says cash is dangerous because inflation eats it. Another says cash is safety. One person says real estate is the only path to wealth. Another says it is too risky. One person says start a business. Another says keep your job and invest steadily. The problem is not that all of these opinions are worthless. The problem is that they are incomplete unless they are connected to your life. Good advice begins with understanding. It asks about goals, fears, responsibilities, time frames, income, debt, family needs, risk tolerance, and past behavior. It does not rush straight to a product or strategy. It does not pretend that one answer fits everyone. It recognizes that money decisions are personal because money is tied to real life. A person who gives advice without understanding the person may be giving information, but they are not giving true guidance. True guidance requires context. This is especially important because many financial mistakes begin with borrowing someone else's conviction. A friend is confident about a stock, so you feel confident too. A co-worker made money from a trend, so you feel behind. A financial commentator sounds serious, so you assume they must know. A successful person tells a story about how they built wealth, so you try to copy the method. But copying the method without copying the circumstances can be dangerous. You may not have the same income, the same risk tolerance, the same timeline, the same safety net, or the same ability to recover from loss. People often forget that every financial decision exists inside a life. A person with a large emergency fund can take certain risks that another person cannot. Someone with no dependents may have flexibility that a parent does not. Someone with a secure job may think differently from someone whose income changes every month. Someone with 25 years before retirement can handle market volatility differently than someone who needs the money soon. Advice that ignores these realities can push people toward choices that look smart from the outside but feel wrong once pressure arrives. The danger becomes stronger when advice is delivered with urgency. Urgency weakens judgment. When someone says, "You need to act now," the emotional brain wakes up. Fear of missing out appears. Fear of loss appears. The person begins to imagine regret. What if this is the opportunity they miss? What if this is a warning they ignore? What if everyone else moves and they stay behind? Urgency makes it harder to pause. But many good financial decisions do not require instant action. In fact, many bad financial decisions happen because a person acts before thinking. A better response to urgent advice is to slow down. A pause does not mean doing nothing forever. It means giving yourself space to think clearly. Ask whether the advice fits your goals. Ask what would happen if the advice is wrong. Ask whether the person giving advice understands your situation. Ask whether you are reacting to fear, greed, envy, or pressure. Ask whether this decision will still make sense if the market moves against you next month. These questions can protect you from turning someone else's opinion into your own mistake. Another problem with predictions is that people judge them unfairly after the fact. If a prediction happens to be right once, they may treat the person as a genius. But being right once does not prove someone can predict consistently. In financial life, luck and skill can look very similar in the short term. A person can make a bold call, be correct, gain attention, and then become trusted far beyond what is reasonable. Meanwhile, many wrong predictions are forgotten. The public remembers a dramatic correct call and ignores the long list of misses. This creates a false sense of authority. For everyday financial behavior, this means we should not build our lives around predictions. A strong plan should not require knowing exactly what the market will do next. It should be able to survive different possible futures. This is why diversification matters. This is why emergency savings matter. This is why debt control matters. This is why investing according to time frame matters. These tools do not make life perfect, but they reduce dependence on perfect guesses. A plan that only works if one prediction is correct is fragile. A plan that can survive being partly wrong is stronger. The same lesson applies to business thinking. Many people wait for the perfect economic moment to start, grow, hire, invest, or change direction. They look for certainty before acting. But business, like investing, always includes uncertainty. A thoughtful business owner does not ignore risk, but they also do not pretend they can predict everything. They build margins of safety. They test ideas. They manage cash. They avoid risking everything on one forecast. They make decisions based on resilience, not only optimism. This kind of thinking is calmer and more durable. In personal finance, resilience is more valuable than prediction. A person who has savings, manageable expenses, low unnecessary debt, and a clear plan can handle surprises better than someone who is constantly trying to guess the future. The predictor may look smart when things go their way, but the resilient person can survive when things do not. That is the real advantage. The goal is not to know the future. The goal is to be prepared for more than one future. This leads to a deeper shift in how money should be viewed. Money is not just a tool for chasing returns. It is a tool for building a life. A financial plan should not be measured only by numbers on a statement. It should be measured by whether it supports the person's values, responsibilities, and real priorities. A plan that produces strong returns but creates constant anxiety may not be a good plan for that person. A plan that looks modest but helps someone sleep well, stay consistent, provide for family, and make steady progress may be far more useful. Financial life planning begins by connecting money to meaning. This does not mean becoming emotional in a vague way. It means being honest about what money is supposed to do. For one person, money may represent freedom from a job they dislike. For another, it may represent the ability to support children. For another, it may mean safety after growing up around financial instability. For another, it may mean creative independence, the ability to take a business risk, or the chance to care for parents. These motivations matter because they shape behavior. When a plan is connected to meaning, it becomes easier to protect. Many people never define their financial life clearly. They inherit goals from culture. They assume they should want a bigger house, a newer car, a higher income, a certain lifestyle, or retirement at a certain age. But these goals may not actually reflect their values. They may be chasing a version of success that looks good to others but does not bring peace. Financial planning should create clarity around this. It should help a person ask, what does enough look like for me? Without that question, more could become an endless trap. The idea of enough is powerful because it creates boundaries. Without enough, every achievement quickly becomes a new starting point. Income rises, but spending rises too. Investments grow, but anxiety remains. The person reaches one goal, then immediately compares themselves to someone further ahead. Enough does not mean laziness or lack of ambition. It means knowing what you are working toward, so you do not spend your entire life chasing something undefined. Ambition without definition can become exhaustion. Progress without purpose can become emptiness. A good financial plan should include numbers, but it should not begin and end with numbers. Numbers help show what is possible. They help measure savings, debt, income, expenses, growth, and risk. But numbers cannot decide what matters most. They cannot tell you whether you value time more than status, whether you want stability more than maximum growth, whether you are willing to trade income for flexibility, or whether a certain lifestyle is worth the pressure it creates. Those answers come from personal reflection. This is why planning should involve real conversations, especially when money affects a family. Many couples argue about money because they think they're arguing about numbers, when they are really arguing about values, fear, control, security, or freedom. One person wants to save aggressively because safety matters to them. Another wants to spend on experiences because life feels short. One person fears debt because it reminds them of past instability. Another sees debt as a tool. If they only debate the surface decision, they may never understand the deeper reason behind it. Honest conversation can turn conflict into clarity. A financial plan should also respect the fact that life changes. People often imagine planning as something fixed, like creating a perfect map and following it forever. But real life does not work that way. A job loss, marriage, divorce, child, illness, business opportunity, move, or change in values can reshape the plan. This does not mean planning is useless. It means planning is a process. The value of a plan is not that it predicts every future detail. The value is that it gives direction and helps people make better adjustments when life changes. This is similar to taking a trip. You may know the destination, but the route can change because of weather, traffic, delays, or unexpected turns. Having a map still helps. It keeps you from driving randomly, but you also need flexibility. In financial life, the destination may be stability, independence, retirement, business ownership, family support, or peace of mind. The route may change. The plan should be strong enough to guide and flexible enough to adapt. Many emotional mistakes happen when people confuse changing the plan with failing. They think that if life forces an adjustment, they did something wrong. But adjustment is normal. The real problem is not changing a plan when life changes. The problem is changing a plan every time emotions change. There's a difference between life-driven change and mood-driven change. If your goals, responsibilities, or timeline have changed, the plan may need revision. If you are simply scared by headlines or excited by a trend, the plan may need protection. Financial life planning also encourages people to think beyond investments. Investing matters, but it is only one part of the picture. Spending habits matter. Saving habits matter. Career decisions matter. Insurance matters. Taxes matter. Debt matters. Emergency funds matter. Estate planning matters. Communication matters. Health matters. Time matters. A person can have a good investment portfolio and still have a weak financial life if the rest of the system is ignored. Real planning looks at the whole person, not just the account balance. For example, someone may be focused on earning higher returns while carrying expensive debt. Another person may invest aggressively while having no emergency fund, forcing them to sell investments during a crisis. Someone else may save for retirement, but never discuss money expectations with their spouse. Another may build wealth but sacrifice health, family, and peace to get there. These are not simply technical issues. They are life issues. Money decisions should support the whole life, not create hidden damage in other areas. A plan connected to life also helps people make better trade-offs. Every money decision includes a trade-off, even when it is not obvious. Spending today can reduce options tomorrow. Saving today can limit pleasure today, but create freedom later. Taking a business risk can create opportunity, but also stress. Buying a larger home can bring comfort, but increase pressure. Retiring early can create freedom, but require lifestyle changes. There is no decision without cost. The point of planning is not to avoid trade-offs. It is to choose them consciously. This is important because many people feel regret not because they made a trade-off, but because they never realized they were making one. They worked long hours for money, then later realized they lost time they valued. They bought things to look successful, then realized they had less freedom. They avoided all risk, then realized their money did not grow enough. They chased high returns, then realized they could not handle the stress. Conscious trade-offs reduce regret because the person understands why they chose what they chose. The best financial plan is not the one that looks most impressive to other people. It is the one that helps the person live with more alignment. Alignment means your spending reflects your values. Your savings support your future. Your investments match your time frame. Your risk level matches your behavior. Your work supports your life instead of consuming it completely. Your money choices do not constantly fight against who you are. This kind of alignment creates a quiet form of confidence. That confidence is different from market confidence. It is not based on knowing what will happen next. It is based on knowing that your decisions have a reason. If markets fall, you understand why you own what you own. If someone else gets rich quickly, you understand why you do not need to copy them. If an expert makes a prediction, you can listen without surrendering your plan. If life changes, you can adjust without panic. This is the kind of confidence that comes from purpose. A life-centered plan can also reduce shame. Many people carry embarrassment around money. They may feel ashamed of debt, past mistakes, low savings, lack of knowledge, or decisions they wish they'd made earlier. Shame often makes people avoid the truth. They do not open statements. They do not talk honestly. They delay decisions. They pretend everything is fine. But avoidance makes problems grow. A good plan begins where the person actually is, not where they wish they were. It allows progress without pretending. This matters because financial improvement is rarely one dramatic moment. It is usually a series of small, honest steps. Looking at the truth, spending with more intention, saving a little more, reducing one debt, building an emergency fund, clarifying a goal, having one difficult conversation, making investments simpler, ignoring one unnecessary prediction, avoiding one emotional reaction. These steps may not feel exciting, but they close the gap between knowing and doing. The biggest enemy of this process is noise. Noise pulls attention away from what matters. It says, the next headline is urgent. The next forecast is important. The next trend is your chance. The next expert knows the answer. But a person building a real financial life must learn to separate signal from noise. Signal is connected to your goals, responsibilities, and plan. Noise creates reaction without direction. Signal helps you make better choices. Noise makes you feel busy while pulling you away from progress. In the end, the path is not about becoming perfect with money. It is about becoming more intentional. It is about recognizing that predictions will always exist, advice will always be available, and uncertainty will never fully disappear. But none of that has to control your financial life. You can listen without reacting. You can learn without copying. You can plan without pretending to know everything. You can adjust without panicking. You can build a financial life that reflects your values instead of someone else's opinion. The real strength comes from combining humility with discipline. Humility admits that the future cannot be perfectly predicted. Discipline keeps you from abandoning the plan every time uncertainty appears. Humility keeps you careful with advice. Discipline helps you follow through on what matters. Humility reminds you that no forecast is guaranteed. Discipline reminds you that your behavior still matters even when the future is unclear. A person who understands this stops searching for someone to remove all doubt. They stop giving every prediction the power to change their life. They stop treating money as a contest of intelligence and start treating it as a tool for building stability, freedom, and meaning. They realize that a good financial plan is not just about what to buy or sell. It is about how to live, how to choose, how to respond, and how to stay steady when the world becomes loud. The future will always be uncertain. Markets will rise and fall. Experts will agree and disagree. Advice will come from every direction. Life will bring surprises. But the person with a clear purpose, a realistic plan, and a calmer relationship with uncertainty does not need to be pushed around by every forecast. They can move with patience. They can make changes when changes are truly needed. They can ignore what is not fit. And over time, that steady behavior becomes one of the most valuable financial assets they have. One of the strained problems of modern financial life is that people now have access to more information than ever, but that does not always lead to better decisions. In fact, too much information can make decisions worse. A person can wake up, check market news, read opinions from experts, scroll through social media, see charts, hear warnings, watch predictions, and compare what everyone else is doing before they have even started their day. Instead of feeling informed, they feel pulled in 10 different directions. More information creates more opinions. More opinions create more doubt. More doubt creates more emotional action. This is a major reason people fall into poor money behavior. They believe that if they keep watching, reading, and listening, they will eventually find the perfect answer. But financial markets are not a simple puzzle where every extra piece of information brings complete clarity. Often, every new piece of information creates another question. One expert says the economy is strong. Another says danger is coming. One headline says investors should be optimistic. Another headline says people should prepare for a crash. One person says to buy. Another says to sell. The result is not wisdom. The result is mental overload. When the mind is overloaded, it looks for relief. Sometimes that relief comes through action. The person changes an investment, moves money, stops a plan, starts a new strategy, buys something popular, sells something after a drop, or keeps delaying because they feel unsure. The action creates a temporary feeling of control. It feels better than sitting with uncertainty. But the action may not be connected to a long-term goal. It may only be a reaction to noise. This is where information becomes dangerous. It does not help the person think better. It pushes the person to react faster. There's a difference between useful information and financial noise. Useful information helps a person understand their own situation more clearly. It helps them make decisions connected to their goals, time frame, risk level, and responsibilities. Noise creates urgency without direction. Noise makes everything feel important. Noise makes short-term movement feel like a long-term signal. Noise turns a normal market decline into a personal crisis. Noise turns someone else's success into pressure. Noise makes patience feel foolish and action feel necessary. For many people, the easiest money mistake is not making one huge bad decision. It is making many small unnecessary decisions. They adjust too often. They check too often. They compare too often. They listen to too many voices. Each decision may seem small, but over time, constant adjustment can damage the plan. A person may begin with a reasonable strategy, then slowly weaken it by reacting to every new fear. They may move away from their goals without noticing because every change felt reasonable at the time. This is especially true with investing. When account values are visible every day, people start treating long-term money like a daily scorecard. If the number goes up, they feel smart. If it goes down, they feel worried. But a long-term plan cannot be judged properly by daily movement. Markets move constantly. Prices change because people are reacting to news, expectations, fear, excitement, and surprises. Watching every movement can make normal volatility feel like a message. The investor begins to ask, what does this mean? When sometimes the honest answer is, not much for your long-term life. Checking too often can turn patience into anxiety. Imagine planting a tree and digging it up every morning to see whether the roots are growing. The attention does not help the tree. It damages the process. Money can work in a similar way. Long-term decisions need time. Saving, investing, paying down debt, building a business, changing habits, and creating stability do not produce perfect results overnight. Constant checking does not speed up the process. It often makes the person more emotional and less consistent. This does not mean people should ignore their finances completely. Avoidance is not the solution. A person should know where their money is, what they own, what they owe, what they spend, and whether their plan still fits their life. But there's a healthy level of attention and an unhealthy level of obsession. Healthy attention is scheduled, calm, and connected to decisions that matter. Obsession is constant, emotional, and usually triggered by fear or comparison. The difference is not only how often you look, it is what looking does to your behavior. If checking your accounts helps you stay aware and responsible, it can be useful. If checking makes you panic, chase, compare, or change direction too often, then it becomes harmful. The same tool can help one person and hurt another because behavior matters. Some people can see market movement and remain calm. Others see the same movement and feel pressure to act. Knowing yourself is part of the plan. If too much information makes you a worse decision maker, then reducing information is not ignorance. It is discipline. A clear plan should decide in advance what information deserves attention. For example, if you are investing for retirement 20 years from now, daily market updates may not deserve much power over your choices. If you are building an emergency fund, the most important information may be your monthly spending and savings rate, not stock market forecasts. If you are paying off debt, your interest rates and repayment behavior matter more than economic commentary. If you're planning a business move, cash flow and customer demand may matter more than general opinions online. The right information depends on the goal. This is why simplicity is so valuable. A simple plan reduces the number of decisions a person must make. It creates fewer opportunities for emotion to interfere. When the plan is too complicated, every market change creates uncertainty. The person has too many moving parts to monitor. They may not understand why they own certain things, or when they should change them. Complexity can make people feel intelligent in calm times, but it can make them fragile during stress. Simple plans are easier to understand, easier to explain, and easier to follow when the world becomes noisy. A good financial life often requires intentional limits. You may need to limit how often you check investments. You may need to limit the number of experts you follow. You may need to limit conversations that make you feel pressured. You may need to limit financial content that creates anxiety but offers no practical value. These limits are not about hiding from reality. They are about protecting your ability to make calm decisions. A person who consumes every opinion may feel informed, but they may also become less grounded. The next important idea is that plans are useful, but they are never perfect forever. Many people misunderstand financial planning. They think a plan should predict the future accurately. They imagine that if the plan is good enough, life will unfold exactly as expected. But life is not that clean. A plan cannot know every job change, market cycle, family need, health issue, opportunity, mistake, or surprise that will happen over the next decade. No plan can remove uncertainty. The value of planning is not prediction. The value is direction. A plan gives a person a starting point. It helps them decide what matters, what to prioritize, what to ignore, and how to respond when conditions change. Without a plan, every surprise feels like chaos. With a plan, surprises are still uncomfortable, but they can be handled with more structure. The plan says, this is what we're trying to do. This is why we're doing it. These are the trade-offs we already accepted. These are the parts we can adjust if needed. That kind of clarity is powerful. The mistake is treating a plan like a promise from the future. People can become discouraged when reality does not match the original version. They may think the plan failed because income changed, expenses rose, markets fell, or goals shifted. But the plan did not fail simply because life changed. A financial plan is supposed to be reviewed and adjusted. The real failure is not adjusting when the facts change, or making emotional changes when the facts have not changed. The wisdom is knowing the difference. Life-driven changes are different from emotion-driven changes. A life-driven change happens when something real has shifted. You get married. You have a child. You lose a job. You start a business. You move cities. Your income changes. Your health changes. Your responsibilities change. Your timeline changes. In those moments, it makes sense to revisit the plan. The old plan may still have value, but it may need a new shape. Emotion-driven changes happen when fear, excitement, envy, or panic pushes you to act even though your real goals have not changed. The market drops, and you want to abandon the plan. A friend makes money, and you want to chase. A headline scares you, and you want to move everything. These changes are not always wisdom. Often they are reactions. A strong plan must be flexible enough for life, but firm enough against emotion. This balance is not easy. If a plan is too rigid, it can break when life changes. If it is too loose, it can be changed every time a feeling appears. The goal is to create a plan that has principles. The details can adjust, but the principles remain. For example, the principle may be to live below your means. The exact budget may change. The principle may be to keep enough cash for emergencies. The exact amount may change as life changes. The principle may be to invest for long-term goals. The exact allocation may change with age, risk tolerance, or responsibilities. Principles create stability without pretending life will never move. This idea is important because people often use uncertainty as an excuse to avoid planning. They say, "Why make a plan if everything can change?" But that is exactly why a plan is needed. A plan is not useful because the future is certain. It is useful because the future is uncertain. It gives a person a way to make decisions when the future becomes messy. It reduces the need to start from zero every time something happens. It helps prevent panic. Think about a family that has no emergency fund, no spending plan, no insurance review, no debt strategy, and no investment direction. When a problem appears, every decision becomes urgent. They may borrow under pressure, sell at the wrong time, argue about priorities, or make rushed choices. Now imagine another family with a clear plan. They still suffer when life gets hard, but they have options. They know what cash is available. They know which expenses can be reduced. They know which accounts are for long-term goals and should not be touched unless necessary. They know what matters most. The plan does not remove pain, but it reduces chaos. A financial plan also helps people make peace with trade-offs. Every plan says yes to some things and no to others. If you save more, you may spend less now. If you spend more on comfort today, you may delay freedom later. If you take more risk, you may face more volatility. If you avoid all risk, you may limit growth. If you start a business, you may gain independence but accept uncertainty. If you keep a stable job, you may gain security but sacrifice some freedom. Planning forces these trade-offs into the open. That can feel uncomfortable, but it is healthier than pretending you can have everything without cost. The best plans are not built around fantasy. They are built around reality. They include the person's actual habits, not just their ideal habits. They include emotional limits, not just mathematical possibilities. They include room for mistakes, not perfect discipline every month. A plan that assumes you will suddenly become a completely different person may look impressive, but it may fail quickly. A better plan respects who you are while helping you improve. It builds systems that make better behavior easier. For example, if someone struggles with overspending, the plan should not simply say, "Spend less." That is too vague. It might create automatic transfers to savings before money reaches the spending account. It might set clear categories. It might remove easy access to credit cards in moments of weakness. It might schedule a weekly money check-in. It might create a pause before large purchases. The goal is not to rely only on willpower. The goal is to build a structure that supports behavior. The same applies to investing. If someone knows they panic during downturns, the plan should prepare for that. It might include a written reminder of why the investments were chosen. It might reduce risk to a level the person can actually tolerate. It might limit account checking. It might create rules for when changes can be made. It might involve talking to a trusted advisor before selling. Again, the goal is to design for real human behavior, not imaginary perfect behavior. As plans meet real life, emotions become unavoidable. Money is emotional because it touches almost everything people care about. It affects where they live, how safe they feel, how they care for family, how they see themselves, how others see them, and how much freedom they believe they have. Because of this, financial decisions often carry more emotional weight than people admit. A decision about spending may really be a decision about identity. A decision about saving may really be about fear. A decision about investing may really be about hope or regret. A decision about debt may carry shame. A decision about work may carry pride, pressure, or exhaustion. Fear is one of the strongest financial emotions. Fear can be useful when it warns people to avoid real danger. It can remind someone not to take reckless risks or ignore responsibilities. But fear becomes harmful when it takes control. In investing, fear can push people to sell during a downturn, locking in losses and abandoning a long-term plan. In business, fear can prevent someone from taking a reasonable opportunity. In personal life, fear can make a person hoard money without ever enjoying it, even when they are financially secure. Fear does not always protect. Sometimes it traps. Greed is another powerful emotion, but often disguises itself as confidence. When people see others making money quickly, they may begin to believe they are missing something. They want faster growth. They want bigger returns. They want to catch up. Greed makes risk look smaller than it is. It makes patience feel slow. It makes simple plans feel boring. It convinces people that this time is different, that they are early, that they understand something special. But greed often appears strongest near moments of high excitement, when prices are already inflated and caution is most needed. Regret also shapes money behavior. People regret not investing earlier, not buying a certain asset, not selling before decline, not saving more, not starting sooner, not choosing a different career, or not avoiding debt. Regret can teach, but it can also distort. A person who regrets missing one opportunity may chase the next one too aggressively. A person who regrets losing money may become too cautious forever. A person who regrets spending too much may become harsh with themselves and avoid healthy enjoyment. Regret should be used as information, not as punishment. Envy is especially dangerous because it makes personal goals disappear. When you compare your financial life to someone else's, you begin measuring yourself against incomplete information. You see the house, the car, the vacation, the business success, or the investment win. You do not see the debt, stress, risk, family help, timing, private sacrifices, or emotional cost behind it. Envy turns someone else's visible result into your private pressure. It makes your own plan feel too slow or too small. But another person's life is not a reliable financial plan for you. Shame may be the quietest but most damaging emotion. Shame makes people hide. They hide debt, mistakes, confusion, low savings, or fear. They avoid opening statements. They avoid conversations. They delay asking for help. Shame tells them they should already know better. But money mistakes are common because money decisions are complex and emotional. The way forward is not pretending the past did not happen. The way forward is looking honestly at the present without letting shame control the next decision. Excitement can also create problems. Not all harmful decisions feel bad. Some feel inspiring. A new business idea, a new investment, a new strategy, or a new lifestyle goal can create energy. That energy can be useful, but it can also make people ignore risk. Excitement focuses on the upside. It imagines the best-case scenario. It makes details feel less important. A person may commit money, time, or reputation before fully understanding the trade-offs. Good decisions can include excitement, but they should not be driven only by excitement. The key is not to eliminate emotions. That is impossible. The key is to recognize emotions before they become actions. A person can say, "I am afraid right now," without immediately selling. They can say, "I feel envy right now," without copying someone else. They can say, "I feel excited right now," without rushing. They can say, "I feel ashamed," without hiding. Naming the emotion creates distance. It allows the thinking mind to return. It creates a pause between feeling and decision. This pause is one of the most practical tools in financial behavior. Many money mistakes would be avoided if people simply waited before acting. Wait before buying an investment everyone is praising. Wait before selling because of panic. Wait before making a large purchase to change your mood. Wait before borrowing to impress others. Wait before changing a plan because of one headline. Waiting does not mean refusing to act. It means refusing to let emotion choose the timing. A useful question in that pause is, what changed? If your goal has not changed, your time frame has not changed, your needs have not changed, and only your mood has changed, then the plan may not need to change. If something real has changed, then adjustment may be wise. This question is simple, but it separates emotional movement from thoughtful movement. It brings the person back to facts. Another useful question is, will this decision still make sense when this feeling passes? Fear passes. Excitement passes. Envy passes. Shame softens when faced honestly. But financial decisions can last for years. Debt can last. Investment losses can last. Missed opportunities can last. Broken trust in a family can last. Before making a decision under emotion, it helps to imagine your future self looking back. Will future you understand this choice? Will they see discipline or reaction? Will they see alignment or pressure? Good financial behavior is built through practice. No one becomes calm with money just by understanding the idea once. Markets will still scare people. Social comparison will still appear. Mistakes will still happen. But the goal is progress. Each time a person notices an emotion before acting, the gap becomes smaller. Each time they return to the plan, instead of reacting to noise, discipline becomes stronger. Each time they talk honestly instead of hiding, shame loses power. Each time they choose a goal over comparison, confidence grows. This is why money is such a powerful mirror. It reveals what people fear, what they value, what they avoid, what they chase, and what they believe will make them safe. Improving with money is not only about learning financial terms. It is about understanding yourself. The person who understands their emotional patterns can design better systems. The person who ignores those patterns may keep repeating the same mistakes with different products, different markets, and different excuses. The deeper lesson is that financial peace comes less from controlling the outside world and more from managing the inside response. You cannot control every headline. You cannot control market returns. You cannot control what other people do. You cannot control whether experts disagree. You cannot control every surprise life brings, but you can control how often you check, whose advice you allow in, how clearly you define your goals, how honestly you face your habits, and whether you pause before acting. These are not small things. Over time, they shape the entire financial life. When information is filtered, plans are flexible, and emotions are understood, money decisions become calmer. They are still not perfect, but they become more intentional. The person no longer treats every headline as a command. They no longer expect a plan to predict every detail. They no longer let fear, greed, regret, envy, shame, or excitement secretly drive the car. They begin to see that the most important financial work is not always dramatic. Sometimes it is simply staying steady, reviewing wisely, adjusting when life truly changes, and refusing to let temporary emotion destroy long-term progress. This kind of behavior may not look impressive from the outside. It may not create exciting stories, but it creates something more valuable, a financial life that is quieter, clearer, and more connected to reality. The person becomes less reactive and more responsible, less distracted and more focused, less controlled by noise and more guided by purpose. In a world where everyone is being pushed to pay attention to everything, the ability to ignore what does not matter becomes a real advantage. In a world where plans are either worshipped as perfect or abandoned too quickly, the ability to adjust calmly becomes a strength. And in a world where money emotions are often hidden or denied, the ability to face them honestly becomes one of the most important forms of financial wisdom. One of the hardest lessons in money is accepting that most of the things people worry about are outside their control. A person cannot control what the market does tomorrow. They cannot control interest rates, inflation, government policy, business cycles, sudden recessions, global events, or whether a certain investment becomes popular or unpopular at the exact moment they want it to. They cannot control whether other people make money faster, whether headlines become frightening, or whether experts suddenly change their opinions. But they can control something far more important than they usually realize. They can control their own behavior. This sounds simple, but it is one of the most difficult ideas to live by. People naturally want to control outcomes. They want the investment to go up after they buy it. They want the market to recover when they feel nervous. They want their savings to grow quickly. They want their business decision to succeed immediately. They want every careful choice to produce a clean reward. But financial life does not work that way. A good decision can still lead to a disappointing short-term result. A bad decision can sometimes look successful for a while. The outcome does not always prove whether the behavior was wise. This is where many people become confused. They judge their decisions only by what happened afterward. If they bought something and it went up, they think they were smart. If they bought something and it went down, they think they were wrong. If they sold before a drop, they think they are good at timing. If they sold before recovery, they feel foolish. But results alone can be misleading, especially in the short term. Luck, timing, and randomness can make a weak decision look good or a strong decision look bad. The better question is not only, did this make money? The better question is, was this decision connected to my plan, my goals, and the things I can actually control? A person who focuses only on outcomes becomes emotionally unstable because outcomes are always moving. Their confidence rises and falls with every result. When the market is up, they feel brilliant. When it is down, they feel anxious. When a friend makes money, they feel behind. When a headline warns of danger, they feel unsafe. Their mood becomes tied to things they cannot command. This makes financial life exhausting. They are not just managing money. They are being dragged around by every result. A healthier approach is to separate process from outcome. The process is what you do consistently. It includes saving a portion of income, spending with intention, keeping debt under control, building emergency reserves, investing according to time frame, staying diversified, keeping costs reasonable, reviewing the plan calmly, and refusing to make sudden decisions from fear or excitement. The outcome is what happens after that, and the outcome will never be completely controllable. The person who understands this does not stop caring about results, but they stops letting short-term results define their intelligence, identity, or next move. This is especially important in investing. The market does not reward emotional control every single day. Sometimes a disciplined investor will watch risky people make quick money. Sometimes a person following a simple long-term plan will feel boring while others talk about exciting opportunities. Sometimes a patient choice will look wrong for a while. That is emotionally difficult. But the goal is not to look smart every month. The goal is to behave in a way that gives long-term success the best chance to happen. That requires patience during periods when patience feels unrewarded. Control begins with knowing what belongs to you and what does not. Market returns do not belong to you. Other people's choices do not belong to you. Economic surprises do not belong to you. Past mistakes cannot be changed, but your savings rate belongs to you. Your spending choices belong to you. Your reaction to fear belongs to you. Your willingness to pause before acting belongs to you. Your ability to ask better questions belongs to you. Your decision to build a plan before choosing products belongs to you. These things may seem small compared to market movement, but over time, they are powerful because they are repeatable. A person can waste years trying to control the uncontrollable. They may spend hours reading predictions, watching charts, checking prices, and searching for signals. They may believe that if they pay enough attention, they can avoid pain. But constant attention does not equal control. Sometimes it only increases anxiety. The more they watch, the more they feel pressure to act. The more they act, the more chances they create for mistakes. In trying to control the market, they lose control of themselves. The opposite path feels less dramatic. It asks for humility. It says, I do not know exactly what will happen next, so I will build a plan that does not depend on knowing. This is not weakness. It is wisdom. A person who admits uncertainty can make stronger decisions because they stop pretending they can predict every turn. They prepare instead of guess. They diversify instead of bet everything on one idea. They keep emergency funds instead of assuming nothing bad will happen. They invest according to time frame instead of mood. They create rules before emotions arrive. Rules are useful because they protect behavior when feelings become intense. A person may decide in advance that they will not sell long-term investments during a panic without waiting and reviewing the plan. They may decide that any large purchase must wait 24 or 48 hours. They may decide that new investment ideas must be checked against their goals before money moves. They may decide to review accounts monthly or quarterly instead of daily. These rules are not meant to make life rigid. They are meant to create a pause between emotion and action. The pause is where control returns. Without a pause, fear can become selling, excitement can become buying, envy can become copying, and shame can become hiding. With a pause, the person can ask, what am I feeling right now? And is this feeling giving me useful information, or is it pushing me toward a mistake? This small space can change the entire direction of a financial life. Many bad decisions are not made because people lack intelligence. They are made because people act too quickly while emotion is still in charge. Controlling behavior also means accepting that consistency matters more than intensity. Many people try to fix their financial life with a burst of motivation. They create a strict budget, promise to save aggressively, decide to invest perfectly, and expect everything to change quickly. But motivation rises and falls. A system is more reliable than motivation. Automatic savings, simple spending limits, regular reviews, and clear goals can keep working even when motivation is low. The person does not need to feel inspired every day. They only need a structure that makes the next good action easier. This applies to spending as much as investing. A person cannot control every price in the economy, but they can control whether they spend unconsciously. They cannot control every unexpected expense, but they can build a cushion. They cannot control every desire, but they can create a habit of asking whether a purchase supports their real life or only a temporary mood. Many people lose control financially not through one disaster, but through repeated small choices made without attention. A subscription here, an impulse purchase there, a lifestyle upgrade after every income increase, a habit of using spending to relieve stress. Each one seems minor, but together they shape the future. The goal is not to become extreme or joyless. Controlling behavior does not mean never spending, never taking risk, or never enjoying money. It means choosing consciously. There is a difference between spending because something genuinely matters and spending because you're bored, anxious, or trying to prove something. There is a difference between taking a thoughtful risk and gambling because you feel behind. There is a difference between adjusting a plan and reacting to noise. Control does not remove freedom. It creates better freedom because choices become aligned instead of impulsive. One of the most powerful forms of control is refusing to compare. Comparison is dangerous because it makes you measure your process against someone else's visible result. You may be saving steadily, reducing debt, and building a healthier foundation, but then you see someone making money quickly and your progress suddenly feels small. Nothing actually changed in your life, but your feelings change because of someone else's story. If you act from that feeling, you give away control. You let another person's situation become the driver of your decisions. A better response is to return to your own plan. What are you building? What matters to you? What risks can you actually handle? What time frame are you working with? What responsibilities do you carry? These questions bring attention back to reality. They remind you that another person's result is not your instruction. Someone else may have different resources, different luck, different hidden costs, or a different tolerance for risk. Their path may not fit your life. Protecting your plan from comparison is a form of discipline. Another important part of behavior is learning how to respond when mistakes happen. Everyone makes financial mistakes. They overspend, invest at the wrong time, wait too long, panic, chase, borrow, ignore warning signs, or avoid the truth. The mistake itself matters, but the response matters even more. Some people turn one mistake into a pattern because they refuse to look at it honestly. Others punish themselves so harshly that shame takes over. Better behavior begins by studying the mistake without letting it define you. What emotion was present? What assumption was wrong? What system was missing? What rule could prevent this from happening again? This turns mistakes into education. A person who panicked during a market drop learns that their risk level may have been too high. A person who overspent after a stressful week learns that stress needs a healthier outlet. A person who chased a trend learns that excitement can distort judgment. A person who ignored debt learns that avoidance increases pressure. The goal is not to pretend mistakes are harmless. The goal is to use them wisely. A mistake examined honestly can improve future behavior. A mistake hidden by shame often repeats. The deepest shift is moving from outcome obsession to behavior ownership. Instead of saying, "The market ruined me," the person asks, "Did I build a plan that could survive volatility?" Instead of saying, "I missed the opportunity," they ask, "Was I chasing something outside my goals?" Instead of saying, "I can never save," they ask, "What system would make saving automatic?" Instead of saying, "I am bad with money," they ask, "What specific behavior needs to change?" This kind of thinking gives power back to the person. It does not control the world, but it controls the response. Over time, the person who focuses on behavior becomes calmer. They still experience uncertainty, but they are not shocked by it. They still see market movement, but they do not treat every movement as a command. They still feel emotions, but they do not obey every emotion. They still make mistakes, but they learn from them faster. Their financial life becomes less about dramatic reactions and more about steady alignment. They become less interested in proving they are smart and more interested in making choices they can live with. This is the kind of discipline that quietly compounds. Saving regularly compounds. Avoiding panic compounds. Avoiding unnecessary debt compounds. Ignoring noise compounds. Having honest conversations compounds. Choosing a simple plan and staying with it compounds. None of these behaviors may feel dramatic on one single day, but repeated over years, they become powerful. The person may not control every result, but they control the habits that give good results a better chance. In the end, money rewards behavior more than people expect. Not perfectly, not instantly, and not always in a straight line, but over time. The person who understands what they can control stops fighting the wrong battle. They stop trying to force certainty from the market, force confidence from predictions, or force peace from perfect outcomes. They begin building peace through the choices that are actually theirs. They save with intention. They spend with awareness. They invest with patience. They plan with humility. They react with restraint. That is the real advantage. Not knowing the future. Not finding the perfect product. Not beating everyone else. The advantage is become the kind of person who does not destroy their own progress when uncertainty appears. The market can move, headlines can shout, experts can argue, and other people can rush in every direction. But a person who controls their behavior has an anchor. They may not control the waves, but they can control how they steer. And in financial life, that can make all the difference. Money becomes much harder when people are afraid to talk about it honestly. A person may make a mistake, carry debt, feel confused, overspend, avoid saving, or feel behind. But instead of facing it clearly, they hide it. They hide it from their family, from their partner, from friends, and sometimes even from themselves. They stop opening statements. They avoid checking balances. They give vague answers when someone asks about money. They pretend things are fine because the truth feels uncomfortable. But hidden money problems rarely become smaller. Silence usually gives them more power. Honest conversations about money are difficult because money is not just numbers. It carries emotion. It can carry shame, pride, fear, guilt, control, insecurity, and comparison. One person may see money as safety because they grew up without enough. Another may see money as freedom because they felt trapped by financial pressure. One person may want to save every extra dollar because uncertainty scares them. Another may want to spend on experiences because they believe life should be enjoyed now. When these deeper meanings are not understood, people think they are arguing about budgets, bills, or investments, but they are really arguing about what money represents. This is especially true in relationships. Couples often believe the problem is that one person spends too much or the other saves too much. But underneath that argument may be two different emotional histories. The saver may not be trying to control the other person. They may be trying to feel safe. The spender may not be careless. They may be trying to feel alive, rewarded, or free after years of pressure. If both people only attack the behavior, they may never understand the need behind it. Honest conversation does not mean blaming each other. It means getting curious enough to understand what is really happening. The same applies to families. Parents may avoid talking to children about money because they do not want to worry them. Adult children may avoid talking to parents because they feel embarrassed or judged. Business partners may avoid financial tension because they do not want conflict. Friends may avoid admitting they cannot afford something because they fear looking unsuccessful. But silence creates confusion. When people do not talk clearly, assumptions take over. One person assumes the other understands. Another assumes everything is fine. Problems grow in the space where honesty should have been. A healthier financial life requires telling the truth earlier. This does not mean sharing every private detail with everyone. It means being honest with the right people at the right time. If debt is growing, it needs to be faced. If spending is out of control, it needs to be named. If an investment decision is creating anxiety, it needs to be discussed. If a couple has different goals, they need to talk before resentment builds. If someone does not understand their plan, they should ask questions instead of pretending. Pretending may protect pride for a moment, but it weakens the future. One of the most powerful things a person can say is, "I do not know." Many people are afraid of those words because they think money knowledge should already be obvious. But money is complicated, and pretending to understand can be expensive. A person who admits confusion can learn. A person who hides confusion may follow bad advice, buy products they do not understand, take risks they cannot handle, or avoid planning altogether. There is strength in asking simple questions. There is strength in slowing down. There is strength in admitting that you need clarity before making a decision. Honesty also helps reduce shame. Shame grows in secrecy. When a person believes they're the only one who has made mistakes, they feel isolated. But financial mistakes are common. People panic sell. People overspend. People ignore debt. People chase trends. People delay saving. People compare themselves to others. People make emotional choices and later regret them. The goal is not to pretend mistakes did not happen. The goal is to bring them into the light, understand them, and build better systems going forward. This is where the final message becomes clear. Good financial behavior is often simple, but simple does not mean easy. It is simple to say, spend less than you earn. It is simple to say, save consistently. It is simple to say, stay invested for the long term. It is simple to say, ignore noise. It is simple to say, do not compare yourself to others. But living these ideas in real life is hard because emotions are involved. Fear makes patience hard. Greed makes simplicity feel boring. Shame makes honesty hard. Envy makes personal goals feel too small. Uncertainty makes people want to act even when action is not needed. This is why the real work is not only learning what to do, it is learning how to behave when doing the right thing feels uncomfortable. The right choice will not always feel good in the moment. Saving may feel restrictive when you want relief. Staying invested may feel scary when markets fall. Avoiding a trend may feel foolish when everyone else is excited. Having an honest money conversation may feel awkward before it becomes helpful. Building wealth slowly may feel frustrating when the world celebrates fast wins. But financial maturity is the ability to keep choosing what supports your life, even when emotion pulls you somewhere else. Simple money behavior becomes powerful because it can be repeated. A person does not need to predict a market perfectly. They do not need to find the best investment every year. They do not need to copy every successful person. They do not need to respond to every forecast. They need a clear purpose, a realistic plan, and the discipline to keep returning to that plan. They need to know what they can control and what they cannot. They need to accept that uncertainty is normal. They need to stop treating every feeling as command. The most important financial skill may be the ability to pause. Pause before reacting to fear. Pause before chasing excitement. Pause before spending to impress. Pause before hiding from a mistake. Pause before accepting advice that does not fit your life. In that pause, a person can ask better questions. Does this choice match my goals? Has my life actually changed, or only my mood? Am I acting from a plan or from pressure? Will this decision still make sense after the emotion passes? These questions can protect years of progress. A strong financial life is not built by one perfect decision. It is built by many ordinary decisions repeated with patience. It is built by saving when nobody notices. It is built by avoiding panic when headlines are loud. It is built by having the uncomfortable conversation before the problem becomes larger. It is built by choosing enough instead of endless comparison. It is built by accepting that markets, economies, and other people will always be uncertain, but your behavior can become steadier. In the end, the gap between knowing and doing never disappears completely. Everyone still feels fear, excitement, regret, and pressure. Everyone still makes mistakes, but the gap can become smaller. A person can become more aware of their patterns. They can build systems that protect them from their weaker moments. They can create a plan that fits their real life instead of chasing someone else's. They can stop asking money to provide certainty and start using money to support meaning, stability, independence, and peace. The final lesson is not complicated, but it is deep. Money will always test behavior. It will test patience when things move slowly. It will test discipline when others seem ahead. It will test honesty when mistakes happen. It will test humility when the future is unclear. The people who do well are not always the people with the most information. They are often the people who can stay calm, stay honest, and stay connected to their purpose. Financial peace does not come from controlling everything. It comes from controlling the few things that are truly yours. Your choices, your habits, your reactions, your conversations, your willingness to learn, and your ability to keep going without being ruled by noise. When those things become stronger, money becomes less frightening and less chaotic. It becomes a tool instead of a source of constant reaction. And that is where real progress begins.